Welcome to Chapter 8 in Vol Studies. This is Dynamic Hedging. Today we're going to talk about why options traders use theoretical pricing models. And Natenberg offers two reasons. First, he says a model tells us something about an option's value. We can compare this value with the price of the option in the marketplace, and from this we can choose an appropriate strategy. Natenberg also points out that second, once we have taken a position, the model helps us to quantify many of the risks that option trading entails. Now, in practice, with respect to that first point, I'd like to offer a little bit of a modification. Especially in terms of market making, the reality tends to work in reverse. The traded price is the market's value, and the model allows us to solve for implied volatility. That's why we call it implied volatility, because we derive it from the price that the market gives us. This foundation allows us to compare option trades and eventually construct vol surfaces, like we talked about in the previous chapter. And with respect to the second point, quantifying the various risks allows us to hedge them, fundamental part of market making itself. Remember, models have limitations. Longevity in trading requires you to understand the limitations of your model. Whatever your style of position management tends to be, it should account for your model. And another critical point, all models are probability-based. The important takeaway here, again, dovetails with that idea that a model has limitations. This does require a mature approach to using models. Even if your model is excellent, even if all your inputs are correct and your model is correct, any one trade can deviate tremendously from your expectation. That is normal. Only over a lot of iterations, a large sample, can we ascertain whether or not the model was in fact correct, right? Because even a fair distribution with correct inputs and everything working as expected, we should have outcomes on the tails. Now, for a market maker, a solid model with limitations you can understand and manage is the bread and butter of market making. This allows you to scale, right? Because when your quote unquote edge, your advantage in the marketplace, is sound and reproducible, what do you want? Well, you want to operate like a casino and place more bets. More bets with higher frequency so you can smooth out your variance and achieve your expected value. Now, let's walk through Natenberg's example together. We're going to start with some assumptions and feed them into a pricing model, and then make a trade, follow it throughout the life of the trade, an entire 10 weeks, hedge it, adjust the hedge, and see how we do compared to our expectations. So we start with these inputs: a stock price or a spot price, a time until expiration, and an interest rate. We still need an exercise price, an option type, and of course a volatility. Now, this volatility in this context, feeding it into a pricing model, we are assuming the volatility here, and we are assuming it's correct and constant. We're going to do this with the 100 strike call and an implied volatility of 37.62%. This is provided for us in the book, but just to be clear, feeding these inputs into an option pricer gives us the option's fair value, and it matches exactly what the book tells us, $5.89. So here we have our option in mind, and we're going to go quote the option. What do? Call the trading floor, of course. We literally ask for a two-way market on the June 100 call tied to 97.70. This bit here looking to pay 5.5 is obviously a joke, but the idea is we're hoping to get edge to buy our calls. We think they're worth $5.89. We want to buy them under our theoretical value. This happens frequently. Markets cross, market makers are off, etc. Whatever the case, here we have market makers starting out below our value. So what do? We lift the calls. We buy the June 100 call 89 cents under our theoretical value. Nice trade, right? Well, maybe. We have to see how it actually pans out. So the first order of business is the hedge. Our first step is to offset the model's delta with a position in the underlying. Now, this converts the directionality of the trade into volatility when done properly, right? Because we offset the directional bias of the option. Now we're betting on movement, not movement in one direction, but movement overall. Now, what about our quote? What in the language of our quote indicates that this trade included a hedge? If you said tied up, you'd be correct. Whenever you see this jargon, tied, or sometimes it's laid up, essentially what you're doing here is you are packaging the option with its hedge at the time of trade. Now, if I were to execute this trade, to buy this one lot of June 100 calls with a 50 delta tied to 97.70, I get a long June 100 call, and I get a sale of 50 shares of the underlying at 97.70, the quote-unquote tie price. Carrying on with the example from the text, the hedge position looks like this. We have our one June 100 call, which of course has a 100x multiplier on the underlying stock. This call is at the money, or at the forward. It has a 50 delta. That means it's equivalent to being long 50 shares. And the contract delta for the shares is just 1, because each share has just a 1 multiplier. Here, we offset the call purchase with 50 shares, and we're delta neutral. Of course, that's the initial position. Now, lucky us, we get to manage the position, right? This for us is going to involve tracking the underlying price movement and trading the underlying to adjust our hedge and maintain delta neutrality. That's net zero across the option and the underlying shares. And Natenberg's example uses weekly intervals. We're using the model strictly here. So we're assuming a constant implied volatility as well as constant interest rates. This means we're not, quote unquote, marking to market our option on a day-by-day basis or a real-time basis like we would if we were actually active market makers. Now, following along with the example, after 1 week, our stock moves up $1.80 to 99.5. Using our model to reprice the option, plugging these same things into the option pricer, but of course, new spot price, and now instead of 10 weeks till expiration, we have 9 weeks, right? Again, we're holding the interest rate constant and the vol constant. The updated call price is going to be 646, and the model gives us a delta of 54. Now remember, our initial hedge is short 50 shares, but now after 1 week and our move higher in the stock, our delta is 54. We are now unbalanced. Our option delta changed, but our position in the shares is still the same. We need to adjust or rebalance the hedge to restore this delta neutrality to the position. Looking here at the table, we have our position going into the adjustment. In order to bring this to delta neutral, we need to sell 4 more shares to offset the additional 4 delta coming from the June call. Nothing tricky about this one, strictly speaking. We do this, and we offset our delta. We sold 4 shares at 99.5. Natenberg points out frequently, for a market-making entity, you're operating like a casino. You think you have theoretical edge? If you can validate that, the more bets you make, the better you're going to do, right? Any one bet in particular is susceptible to deviation from your expectation. There's variance implied. The more bets we can make, the better we'll do over time. In this case, when we're breaking down the option and re-hedging it, as spot moves or as time passes, this is called dynamic hedging. This is different than static hedging. Oftentimes when people think about hedging, they think of a set and forget, like the JP Morgan collar, for example. When they establish their position, they have a book of equities, and then they make one trade, which they don't really move for the entire term. The entire term is covered at a level. For example, a long put option protects equities from falling below that level. Now, for a market maker, you're going to be dynamically hedging. You need to rebalance your hedge frequently to eliminate that market exposure as it appears, and doing this is like creating new bets within the bet. Now, carrying on with the example, we go through the entirety of these 10 weeks. We wind up having all these different adjustments. Of course, these are laid out for us in the chapter, and these are consistent with that volatility that we were given, 37.62%. This is important. Remember, this is given to us. This example was obviously created to deliver the output that we're seeing, but fundamentally it illustrates the point that we'll make next. As we start to wrap up the example, we need to take into account the original hedge and the option settlement as well, right? We've now moved through the entire 10 weeks. We've re-hedged at the end of every individual week, and we've modeled the option along the way at a 37.62 implied volatility. Again, in this example, for the sake of illustration, we knew the actual realized volatility ahead of time. So now we're just breaking down the different cash flows and we're validating our experience, right? So here, we paid $5 for the June 100 call and we sold 50 shares at 97.70 to open the position. At expiration, the stock went out 103.85. That leaves us with an intrinsic value of $3.85 for the call itself, But of course, we paid $5 for it. So net, there's a loss here of $115 when you take into account that option multiplier of 100. Additionally, we bought a call, so we sold shares in the underlying. The market moved higher. We lost money on this hedge. 50 shares times the difference between 103.85 and 97.70 comes out to be $307.50 on that original hedge. Combined, the total loss on this original position was $422.50. Now, we just accounted for the initial trade, the option and the hedge associated with it, but we need to account for the hedging activity and the interest paid or received on all the different cash flows. So when we add all the adjustments, cash flows, we have a profit of $467.55. When we then add up all of the different amounts of interest either paid or received on every individual cash flow, those adjustments net a loss of $5.28. The option position itself cost an implied $5.75 to finance, but we earned $56.21 in interest on that cash balance associated with the initial stock sale. Adding up all of these cash flows, we have a total P&L of $90.24 after the 10-week period. What do we still need to do? We need to discount this back to get an initial value or a present value using that 6% interest rate. Doing this yields an initial value of the total P&L of $89.21. $89.21. Why does this seem so familiar? Oh, that's right. You bought the call 89 cents under. For every one lot, that's $89 of edge. As a market maker, you book a P&L like this at the time of trade. Of course, whether or not that materializes is up for debate, right? And that debate is settled day after day after day as you mark to market your overall option position and reconcile the cash flows associated with these different changes to your model. Now, here's a simple table. This is a complete look at all of the individual contributions to the total P&L. You can go through this yourself. I'm not going to go through line by line. This is taken directly from our example. Was this example realistic? Well, yes, more or less, but we relied on some basic assumptions, right? First, we assume that interest rates are constant. We assume volatility is constant. We also assume volatility compounds continuously. What do I mean by this? Just like interests, kind of, but the requirement here is that we are hedging continuously. We assume traders can buy or sell the underlying with no friction for their hedging. We also assume they can borrow or lend freely at the same rate. Furthermore, we assume that all of this stuff is free of transaction cost. And last but not least, in this world, there are no taxes. Now, this is all pretty much in line with reality, right? Maybe not so much. Are interest rates constant? Nope. Luckily for us, this is not a huge problem. Interest rates turn out to be a minor contribution to the overall valuation of an option, and we can account for most of this anyways in the way we construct our interest rate curve. Is volatility constant? Nope, not even close. For a market maker, of course, this is not a very big problem. It just requires us to understand the complexity, these dynamic second and third order Greeks that influence the value of our position. Volatility compounds continuously? Again, not really. The important takeaway here is that we cannot really hedge continuously. It's just unrealistic. We have to choose a hedging frequency and balance out things like cost. Now, again, on the subject of hedging, can we buy and sell the underlying with no friction? Well, not exactly, right? Price is not continuous itself. There are limits, there are gaps, and there are market hours. Can we borrow or lend freely at the same rate? Well, not so easily. Our clearing firms are not so generous. There are ways to approximate the same rate in the open market, but there's friction there as well. Last but not least, is it free to trade? Well, not for us it isn't, right? Sometimes market makers will get rebates, and that can cheapen their overall cost to trade or participate and provide liquidity. But strictly speaking, for our lens here, it is far from free to trade. And of course, last but not least, taxes are always a consideration. Now, here's just another way of looking at your hedge adjustments. Remember, each one is like a new bet. The image on the left shows you that initial starting price, and then what happens after week one when the market moves to 99.5 for our stock.
we become unhedged and have to sell an additional 4 shares at 99.5 to close this gap. Moving over, we see what happens when we go from week 1 to week 2. Price drops considerably and requires us to buy 19 shares to close this much larger gap. Now, some delta hedging considerations. Delta hedging should be continuous, but in reality it's not. Now remember that this requirement for continuous delta hedging just comes back to the idea that volatility is compounding continuously. In reality, of course, there are trade-offs. You have to balance your intention with your costs. Now, how is this done in practice? Well, oftentimes discrete time intervals. For example, it's somewhat conventional to hedge close, right? Because that's the benchmark for how we calculate things like realized volatility over time. Oftentimes it's just the simple SPX close. This provides a nice, simple, discrete time interval with which you can reestablish your delta hedge. This is basic and fundamental. Now, of course, it's probably not what most of the high-frequency market-making firms are doing at this time, but may still be done by banks or volatility-oriented hedge funds. There are other ways too. You can have a delta tolerance. For example, you may accept some degree of delta, and when your position delta moves outside of that band or touches that band, you reset to delta neutral. This is also common. There may also be underlying moves, certain triggers in the underlying itself, where, for example, if you move 1 standard deviation intraday, you're going to be hedging. This is desk dependent, and of course, every single firm may have their own unique approach to doing this, which may provide some of their value added for their market making activity. In theory, a greater hedge frequency should reduce deviation from theoretical edge, right? Because you are resetting the bet. The more bets, the more closely you approximate your expected value and reduce your variance. There are more examples in the text. You can go through them to have a couple of different cases under your belt, but the gist is this. If the actual vol was less than 32.4%, that's just the fair value or the theoretical volatility associated with that $5 price, the position would have then shown a loss to the buyer. That would have materialized in the form of smaller scalps or lesser P&L on your hedge adjustments in that 10-week table. Another lens here, if you were on the other side of this transaction, right? If you were the market maker that sold the option at $5, if we can assume that they had the mirror image of the hedge path, well, then they would have the opposite P&L that we had. They sold that option 89 cents under its fair value at the end, and they would have the exact opposite of the positive $89.21 that we realized. Just some things to keep in mind. Again, I encourage you to go through the examples and reconcile this all in your head. Make it as intuitive as possible before we carry on. Next up, we will carry on with risk measurement and go deeper into the Greeks. See you then.